Hi everyone, welcome to another episode of the Mizuho Week Ahead. I am Jingyi, market economist at Mizuho Bank. The theme for this week is fragile buoyancy. Last week, US equities were broadly buoyed by resiliency of US data, such as retail sales and business outlook. However, signs of tariffs pass-through to affected goods in CPI print underscored a broadly cautious Fed. Nonetheless, the cost of waiting, though, featured with Fed Daily noting that the Fed should not wait too long before moving, and Fed's Waller opining that the Fed should not wait until the labor market deteriorates before moving. This alludes to the increasing opportunity cost of holding rates at restrictive levels, while the Fed awaits incoming data to analyze the impact of tariffs. After all, the tariff situation still remains very fluid, with risks tilted to the downside. Trump released letters threatening 30% tariffs on Mexico and EU imports effective August 1st, while appearing unmoved by EU's concessions on car tariffs. Brazil got the brunt of Trump's trade antagonism with a 50% slap on their exports. In EM Asia, there was welcome relief for Indonesia as tariffs were reduced from 32% to 19%, now one of the lowest in the region. On the sectoral front, Commerce Department announced tariffs on Chinese graphite on anti-dumping grounds, while Trump stated that pharmaceutical goods tariffs would be announced soon. In Asia, while there were multiple GDP upside surprises, things are far from rosy given the underlying data reveals domestic and or subdued manufacturing in the face of tariff headwinds. Singapore's Q2 GDP registered 4.3% year-on-year growth against expectations of 3.6% amid a supportive services sector. However, front-loading impact appears muted in the manufacturing sector despite buoyant export data. GDP print is nonetheless expected to see MAS leaving policy settings unchanged at the July meeting. Meanwhile, China's Q2 GDP outrun at 5.2% against expectations of 5.1% have to be taken into account uneven growth and unrelenting external risks and uncertainties, all of which demand that Beijing keeps an unwavering stimulus. Moreover, unmitigated deflation risks and unrelenting geoeconomic assaults warn of abrupt adverse demand shocks in the offing. Malaysia's Q2 GDP upside at 4.5% against expectations of 4.2% was on the back of resilient services and construction sector, while manufacturing sector moderated. Last week, Bank Indonesia also resumed easing, cutting policy rate to 5.25%, citing the need to boost lending and support growth. Easing bias remains as Bank Indonesia reiterates that it will look for room to further lower rates and even go all out in encouraging bank lending and support economic growth. Down under, the small jobs print in Australia raised the odds of a 25 basis points cut by RBA in August, and that the central bank probably should have eased at the July meeting. Next week, ECB's hold is unlikely to surprise, as comments by ECB Chair in mid-July have already set the stage for a hold. Notably, Chair played down risk of inflation undershooting 2% target amid a firm euro. South Korea is expected to avert a technical recession, but Q2 GDP growth is expected to be marginal on the back of contracting industrial production, weak real retail sales and construction sector. All in, buoyant economic data warns of complacency towards tariff risks, which are ever present. With that, we have come to the end of this episode. For more information on the key events for the upcoming week, please refer to our Week Ahead publication or contact your respective sales desks and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you and bye-bye.